You've probably heard someone say just invest in an index fund, but do you actually know what that means? Or what makes it different from a mutual fund, a hedge fund, or an ETF? In the next 6 minutes, I'm going to break all four of these down in the simplest way possible. No jargon, no fluff. By the end, you'll know exactly which one is meant for you. Let's get into it. Before we compare anything, let's agree on what a fund actually is. Think about splitting the cost of a group dinner with friends. Nobody pays for everything. Everyone chips in, and together you get a full meal. That's the core idea behind a fund. A fund pools money from many investors, and that combined capital is used to buy a variety of assets. Stocks, bonds, real estate, and more. You own a slice of the whole pool. Instead of managing every investment yourself, the fund does the heavy lifting. You participate in the gains and the losses proportionally. Okay, index funds. This is the one you'll hear about most, especially from personal finance creators on social media. An index fund doesn't try to pick winning stocks. Instead, it simply mirrors a market index, a pre-built list of companies designed to represent a portion of the market. The most famous example is the S&P 500, a list of 500 of the largest publicly traded companies in the United States. When you invest in an S&P 500 index fund, your money is spread across all 500 of those companies automatically. There are indexes for almost everything. Tech-heavy ones like the NASDAQ, which includes companies like Apple and Microsoft, broad market indexes covering thousands of stocks, international ones tracking companies in Europe or Asia, even sector-specific ones focused on healthcare or energy. Because index funds don't require a human manager making decisions, they're called passively managed, and that keeps costs incredibly low. Most charge an annual fee called an expense ratio of somewhere between 0.03% and 0.2% annually. On a $10,000 investment, that's $3 to $20 a year. One thing to know, unlike a stock, you can't buy or sell an index fund at any moment during the trading day. Orders are processed once daily after the market closes, at a price called the net asset value. For most long-term investors, that's a complete non-issue. Mutual funds look a lot like index funds on the surface. They pool money from many investors and buy a mix of assets. The key difference is in the management style. Mutual funds are typically actively managed. A professional portfolio manager, sometimes an entire team, is constantly making decisions about which stocks to buy, which to sell, and when to make moves. Their goal is to beat the market, usually measured against a benchmark like the S&P 500. That sounds appealing, but here's the trade-off. Active management is expensive. Mutual fund expense ratios often range from 0.5% to over 1.5% annually. That might not sound like much, but over decades, it compounds into a significant drag on your returns. And here's what the data consistently shows. Most actively managed funds fail to outperform their benchmark over the long run. Not because the managers aren't smart, but because consistently outsmarting the entire market is extraordinarily difficult. That said, mutual funds still have their place. Some investors want exposure to specific strategies, niche markets, or a particular manager's approach. Providers like Vanguard, Fidelity, and JP Morgan offer both actively and passively managed mutual funds, so it's worth reading the fine print before you invest. Now we're entering different territory. Hedge funds are private investment vehicles available only to accredited investors, people with a high net worth or income who meet specific legal thresholds. They're not designed for the average investor, and for good reason. Hedge funds use advanced, aggressive strategies to try and generate outsized returns. Things like short selling, betting that a stock will drop in price, leveraging borrowed money to amplify positions, and trading complex instruments called derivatives. Because of these strategies, the potential upside is high, but so is the downside. Hedge funds can lose significant money quickly, and there's very little regulatory protection compared to retail funds. The fee structure reflects this. Hedge funds are known for the 2 and 20 model, a 2% annual management fee on total assets, plus 20% of any profits the fund earns. For context, that's roughly 10 times what you'd pay with a typical index fund. Unless you're a high net worth individual looking for alternative investment strategies, hedge funds are not relevant to most people watching this video. ETFs, exchange-traded funds, are probably my favorite of the four to explain because they're essentially a hybrid. Like an index fund, an ETF typically tracks a market index and gives you instant diversification across dozens or hundreds of companies. But unlike a traditional index fund, an ETF trades on a stock exchange throughout the day, just like an individual stock. That means you can buy or sell an ETF at 10 in the morning, at noon, or at 3:45 in the afternoon, and you'll see the price update in real time. This gives you more flexibility and control over your entry and exit points. ETFs also tend to have very low fees. Expense ratios typically fall between 0.03% and 0.75% depending on the fund. Many can be purchased through brokerage platforms with zero commission, making them extremely accessible. Want exposure to the S&P 500? There's an ETF for that. The entire US bond market? There's one for that too. Clean energy? International small-cap stocks? Healthcare? There's an ETF for nearly every slice of the market you can imagine. So which one is right for you? For most everyday investors in the United States, index funds and ETFs are the starting point. They're low-cost, broadly diversified, and historically have outperformed most actively managed funds over the long term. They're designed to grow your wealth gradually, not to make headlines. Mutual funds can still make sense if you have a specific investment thesis or want exposure to a niche strategy. Just make sure the higher fees are justified by what you're getting. And hedge funds? They exist, they serve a purpose, but they're not in scope for most of us. If this helped you understand the difference, drop a comment below with which one you're most interested in learning more about. That'll help me decide what to cover next. And if you haven't already, subscribe. I put out videos like this every week breaking down financial concepts that most people spend years figuring out on their own. See you in the next one.